Good morning, everybody. Welcome to the next webinar. Now, last time we discussed something about in terms of risk and return of a portfolio. Risk and return of a portfolio. Now, just to recap what we had earlier done, the return of the portfolio is simply a weighted average. It's a weighted average of the individual returns on each security. Right? So therefore, if you have, let's say, 3 securities, okay, and you have invested your money into across 3 securities, then the proportion invested in security 1 multiplied by the average return of 1 plus x2, that is the proportion that is invested in security 2 into the average return of security 2 plus x3, which is the proportion that is invested in security 3 multiplied by the return that you get on security 3. This will be the return on the portfolio. However, the return on the risk on the portfolio is not a simple weighted average. Right? In this case, if you want to calculate the risk on a portfolio, suppose I take a 2 security case. If I have to calculate the risk on a 2 security case, it would be calculated as the standard deviation of the portfolio would be calculated as the proportion invested in security 1, the square of that, standard deviation of security 1, square of that, plus x2, proportion invested in security 2, multiplied by the standard deviation of security 2, the square of that, plus 2 into proportion invested in security 1, proportion invested in security 2, into the covariance between the 2 securities. Right? Now, when I say covariance between the 2 securities, if I take the covariance of securities can be broken up into correlation coefficient between the 2 into standard deviation of security 1 into standard deviation of security 2. Right? Now, in a typical sense, right, how do I calculate the covariance on a particular? If I have to calculate the covariance between 2 securities, this is how I would do it. Right? Suppose there is a security A and there is a security B. Suppose example 15% rate of return. In the first period, security A has 15%, then 20%, and gives 25%. In the same period, security B gives 16, 18, and 9. Right? So the average return in this case would be 20% for A and 15% for B. Right? Please check the calculations at the same time. Ensure that I haven't made a mistake. A and B. Right? Now, in order to calculate the covariance, what I would do is 15 minus the average 20 into 16 minus 15 plus 20 minus 20 into 18 minus 15, 25 minus 20, 11 minus 15. Right? Just to explain what I have done out here, I have found out the average return on A, that is 20%, and I have found out the average return on B, that is 15%. Right? For each of the returns, right? For example, in the first period, the return on A was 15%. So 15 minus 20. In case of B, the return was in that period was 16%, and the average was 15 into 16 minus 15. See, the idea of covariance is basically to find out how the securities move together. So in that case, we are trying to find how they covariate. So therefore, we try and find out from the average, the deviation from the average from A, multiply the deviation of the average from B in each period. So this becomes 15 minus 20 minus 5 minus 1 into 1, this is minus 5, this is 0, this is 5 into minus 4, This is minus
minus 25.
minus 20. So this becomes minus
25.
25. Right? If I divide, since there are 3 observations, similarly like in standard deviation, you also have n minus 1 in case of covariance in here. So I would divide it by 2, that becomes 12.5. So the covariance in this case is 12.5. If I was able to find out the standard deviation, I would be able to find out the correlation coefficient. Simply, as I said, the covariance, if I divide the covariance between the same two securities by the standard deviation of A and the standard deviation of B, I would find the correlation between A and B. Okay.
Ma'am, 12.5 negative.
This is 12.5, it can be negative. Covariance can be negative. See, the standard deviation cannot be negative. Right? Now, obviously, if the covariance is negative, right? So, if the covariance is negative, it means that the correlation coefficient is negative, because you cannot have a standard deviation which is negative. By the definition, if you are looking at standard deviation, because you take the deviation of the square deviation, so you cannot have which is something which is negative. But on the other hand, correlation can be negative or positive. So, in this case, we are finding a situation where the correlation is negative, right? Now, just to go back on that formula that we had earlier discussed, right, and the importance of the correlation coefficient in trying to reduce the risk on a portfolio. As we had discussed earlier in the last webinar, is that depending on the correlation coefficient, right, there is a possibility of risk reduction of risk to diversification. Lower the correlation coefficient, lower would be the risk. For example, let me take two securities. As example, let's say take the standard deviation of A as 14% and standard deviation of B as 12%, right? And let me take the correlation coefficient. Right? Let me take 3 scenarios. Right? Correlation coefficient is +1. Correlation coefficient is -1. Correlation coefficient is +0.5. Right? Let me take 3 particular scenarios wherein I alter the correlation coefficient. Let me assume that the return on security A is, let's say, 30% and return on B is, let's say, 20%. Right? Now, for the sake of example, again I will assume that we are investing 50% in A and 50% in B. So, in terms of the weighted return, right, there should not be any change. It should be 15 plus 10, 25%. Right? The weighted return, in case I invest 50% in A and 50% in B, therefore the average return on the portfolio is going to be 25%. Right? Now, depending on the correlation coefficient between these two securities, let me see how much of risk I can diversify away. Okay. Now, looking at this formula again, right? If you do it through the traditional way by combining securities, you will find the same result, but this happens to be much easier. Right? This is the formula. Right? Now, let me take a scenario where the correlation coefficient is +1. Okay? Now, 50% in both, right? So, this becomes 0.25, 0.5 into 0.5, 0.25. This is 40, this becomes 196, right? Again 0.25, 0.5 into 0.5, 0.25. This is 144, 12 into 12, 2 into, again 0.5 into 0.5. Correlation is 1 into 14 into, 14 into 12. Right? 196 into 0.25. What would that be? 49. And 144 into 0.25. 26. 2 into 0.5 into 0.5. That's the 0.5.
0.5.
Yeah, into 14 into 12.
84.
So the correlation coefficient is 1. So it remains as 1. Add all those 49 plus 36 plus 84.
169.
Minus 12, 30, 30.
30.
Right? Now, when the correlation coefficient is plus 1, the standard deviation of the portfolio is 30. Okay? Now, let me have a scenario where the correlation coefficient is minus 1. The first does not change. The second does not change.
Minus 80.
This becomes
Minus
minus 84. What is the answer? 49 plus 36 minus 84?
1.
1. So your, and it is minus 1, the standard deviation is only 1. If the correlation is 0.5, so it becomes 42,
Exact.
right? Find the coefficient.
127.
120. Find the square root of that.
27.
And then 0.27. Right? Now, if you look at this particular result, as you can see, that the rest of it does not change. What makes the significant difference is the correlation factor. Right? So, if the correlation was plus 1, I had the maximum amount of this. If it was minus 1, minimum. If it is 0.5, then somewhere in between the two. If the correlation coefficient is plus 1, it simply becomes a weighted average of the two individual standard deviations. Right? If I add these two up and divide by 2, this will come to 13. Right? So, in case the correlation coefficient is 1, right, there is no benefit out of diversification, and the standard deviation becomes simply a weighted average of the individual standard deviations of the securities. Right? Now, as I explained, that it is unlikely to expect negative correlation over long periods of time. What we will try and achieve is positive correlation, but as low correlation as possible to achieve the maximum amount of reduction of risk. Now, this what I have illustrated is the situation which involves finding out the risk of two particular securities. Right? This involves finding out the risk of two particular securities. Right? Now, what if I had a situation where I had, let's say, 3 securities? Right? In this case, the number of elements that I would have was x1, x2 whole square, x3, 3 terms with relating to the proportion and the standard deviation, plus 2x1, x2 into covariance into
X3.
x1, x2, correlation, coefficient, covariance between security 1 and 2, right? Covariance between 1 and 2, then 2 x1, x3, correlation, covariance between 1 and 3, plus 2 x2, x3, covariance between 2 and 3. Right? Now, the number of terms that I have is 1, 2, 3, 4, 5 and 6. Right? So, for 2 securities, I had
4.
2 securities, I had 3 terms, sorry. Right?
3 terms.
For 3 securities, 3 plus 3, 6. Right? For 4 securities, there would be 4 individual terms,
8.
right? Plus 4 into 3 divided by 2 covariance terms. Right? Basically, to find out the covariance terms will be n minus 1 divided by 2. Right? So this would be the number of covariance terms. If I have, let's say, 50 securities, so it will be 50 plus 50 into 49 divided by 2. right? Right? You added the 50 also. In the case, you have to square it. Right? It has to be square. Right? Now, obviously, when the number of securities increases, right, the problem of in terms of finding the covariances between individual securities becomes a very onerous task. Right? Secondly, is the question of finding out the weights of x1, x2, x3. Right? See, there can be numerous permutations and combinations. Right? Now, within the whole realm of portfolio analysis, see what we are trying to figure out is something to this effect. Right? We're trying to find out the efficient frontier. The efficient frontier simply means is that it's likely to be concave. More return, for example, if I plot return out here and risk out here. Right? Now this is a normal. More return, more risk is a it's an acceptable. This is what we do. I think you have more return on the stocks. We are likely to have more risk.
This is for individual securities.
Yes, for individual securities or portfolios, right? But here what we are discussing in the context of portfolios, right? So that means the more the return on a portfolio, the more risk it is likely to be. The idea is that you have to eliminate inefficient portfolios, right? Now suppose in this scenario, suppose I had, let's say, one security here and one security here. This is A and this is B. Right? Which one would you prefer? Between A and
A.
B. Why?
Risk
Risk
is less.
is
For the same return,
Same return.
right?
Risk is less.
You should. The risk is less. Similarly, it was. Which one would you prefer?
C.
For the same
C
amount of
is-
risk, you are getting
Same
amount
more
of
return.
So, by plotting the return and risk possibilities, there are numerous permutations and combinations. So, within that situation, you should always try to figure out that is there any other portfolio which is offering you more return for the same amount of risk, right? Or for the same amount of return offering you a lower amount of risk, right? If that is so, then that is not an efficient portfolio. An efficient portfolio is one which does not, there is no other portfolio for the same amount of return gives you a lower amount of risk, or for a same amount of risk does not offer you a higher return. So we have to try and figure out the most efficient portfolio. Now using this entire estimates in terms of trying to do this, right? For example, as I said, if it was 2 securities, we had 3 estimates. If we have 3 securities, we have 6 estimates. If we have 4 securities, we would have 10 estimates, right? And I can demonstrate it. For example, if you have 4 securities, right, just to look at it. So you have 1, 2, 3 and 4, right? So first you find the covariance 1 and 2. Look at the combinations. 1 and 3, 1 and 4. Then 2 and 3, 2 and 4.
3 and 4.
2 and 3 and 4. Right?
This is
Right? 2 and then 1 second. Then you have 1 and 2, 1 and 3, 2 and 3, 2 and 4. Right? And then you will have 3 and 4. Right, हो गया. So 1, 2, 3, 4, 5, 6. 6 plus 4 individual 10. Right? So as I said, if you want to find out the unique covariance terms, in that case n into n minus 1 divided by 2. Now if we had in a normal portfolio, right, one would expect to have something like at least 25 to 30 securities. For example, we say that if you want to achieve good diversification, right, significant amount of diversification and maximum possible amount of reduction of risk, we should aim to get around 25 to 30 securities where it is possible to diversify risk to a significant extent. To that extent, if we are trying to find 25 securities, there will be so many permutations and combinations. It will be impossible to do it without having these, unless I have a very sophisticated computer and trying to find out in terms of the various mathematical modeling. It becomes a very, very difficult task. Therefore, this entry of the capital asset pricing model, or what we call is known as the market model. Right? Now, can you tell me in terms of market model, and anybody has any idea in terms of capital asset pricing model, what does it mean? Any idea in terms of, have you heard of capital asset pricing model? What does it say? Nobody remembers. Okay, everybody must have come across the term of beta. Yes, ma'am. Right? So, what does beta say?
It measures the systematic risk of the portfolio.
What is systematic risk?
Risk which cannot be avoided.
Risk which cannot be avoided. Is that a correct definition?
Which can be measured.
It can be measured, but it cannot be diversified. Now, basically, what happens is in the capital asset pricing model, very simply defined, is that here the risk is made up of two elements, right? One is diversifiable,
Undiversified.
and one is undiversified. Right? Now, this is also called unsystematic, and undiversifiable is called systematic. It is also known as market risk. Right? Now, what happens in a security is that the risk of a particular security is dependent on three factors. Right? One is economic factors, one is industry specific factors, and one due to the company itself. Right? Now, what is due to the company is something that is only due to the company, and therefore, if we try and combine different securities, so possibly by diversification we can eliminate. Industry specific risk, to a certain extent we can diversify, but economy specific risk, right? It is impossible to diversify because all securities would have some sort of economic risk, so it's not possible to diversify it. Now, if I had a particular prototype or a particular benchmark on which I could base the economy on, right? And if I could tie up the risk and return of each of the securities to this prototype or benchmark, my life would become much more easy, right? And this is exactly what capital asset pricing model does, right? Basically, they say that since the securities risk is divided into systematic and unsystematic, the systematic risk is measured by the relationship with that of the stock market, right? And the stock market, as you all know, is the barometer of the nation, right? It's the barometer of the nation's economy, right? So, if the stock market, the economy is doing well, right? So, to that extent, the stock market is likely to do well. If the economy is not doing well, so to that extent, the stock market is also not likely to do well. If I want to measure the performance of the stock market, what do I do? How do I measure the performance of the stock market?
We take top 30 companies and we
see, there are a variety of ways by which you can do it, right? One, of course, you use indices, right? Indices, of course, one is a BSE 30 index, you have NSE 50, you have NSE 500, right? So there are a variety of indices that you can use as benchmarks, right? So in some cases, we may use, let's say the top 50 or the top 30. But if you want to have a diversified kind of performance in terms of the entire economy, it's probably better to use something like either NSE 500. So that in that case, because the 500 stocks would capture the entire of the economy, right? So it's probably better to have something like an NSE 500, using that as a base for the entire economy. Now, what is beta? Beta is basically before as I said, everybody knows it's a measure of systematic risk. Now, how is beta measured? Right? It is covariance of the securities returns with that of the market divided by the variance of the market returns. Please understand that when I say covariance, it is a covariance of each of the securities returns with that of the market returns, and it is divided by the variance of the market returns, not the prices of the indices, but the variance of the market returns. Similarly, the covariance with respect to the returns and not the prices. Right? You have to find out the returns on the security and then in terms of the prices. Okay. So if I just look at, if I break this up, see the covariance I have already told you is the correlation coefficient between a security and that of the market. So I can write it as this, into standard deviation of the security into standard deviation of the market divided by the variance of the market by this beta can be breaken into the correlation coefficient between the security and the market into the standard deviation of the security divided by the standard deviation of the market. Right? With regard to how to interpret the beta, we will discuss that in our next